what I think is going to happen is that the Fed is going to be forced into having to stop quantitative tightening, uh, probably by year end, because I think reserve balances are going to really start getting too low. Because remember, the TGA is going to refill and it's going to leave the Fed around $3 trillion. And that's sort of getting towards the bottom buffer zone. And then, of course, they're going to continue to do QT, which is another 45 billion a month. So it's 75, you got, 90, 100, and another 200 billion coming off of reserves potentially between now and year end just from QT. And so you could be talking about reserve balances somewhere around 2.8 trillion by year end. And that's really getting close. And so I think the Fed will probably have to finish the program at that point before year end, maybe the November meeting. But I think more importantly is that the Fed is going to then have to switch at some point beginning of next year to where they're no longer, running off the balance sheet. But what they have to do basically, from what I understand, is they want to drain MBS securities. They want MBS to be zero on their books. So that means that they have to offset that. And so to offset that, it means they have to start buying treasury bills. And so it will give the appearance that liquidity is net neutral, but that will take by them starting to buy treasury bills, it will take a significant strain off of risk assets. And if my theory is right, then what I would expect to happen is that you probably want to, when we get this next volatility shock, if it should come, as I'm expecting, that's probably when you want to start, as the market's kind of coming in and going down, that's kind of when you want to start putting cash back to work. Because when the Fed starts to buy bills, like I said, that's going to take a tremendous strain off of dealer balance sheets. And that will probably allow for the liquidity flows to start moving again. And that's probably when you get a nice rally in the market again.